Thank you for joining us. I'm Tom Perrone from New England Consulting Group, and today we're going to do a presentation on Medicaid confiscation, and it's part of our All in the Numbers presentation series. And today we're going to talk about the confiscation of assets due to the Medicaid system, and it's a project that my associates Jamie Cowan and Armin Abrahamian have been working on to help families either recover their assets lost through this system or retain some of them, if not all of them. And we have systems that work. And today we're going to bring you through the system itself. So the first thing I'm going to do is get this a little bit bigger so everybody has a... So today we're going to again spend time, about 10 minutes, on Medicaid confiscation. And we're going to introduce to you the 1% solution. Now, let's first of all talk about how the system works, the Medicaid system. If a spouse were to become sick where they needed confinement and they went into care, the state of Connecticut currently would say to that family, you can keep 50% of your assets up to $123,000. And of course, this figure will change yearly, a nominal amount. You can then keep the balance of those assets have to then be spent down for the care of that institutionalized person. But the spouse gets to keep the 123 of the assets. I'll give you an example in a few minutes. Exceptions and exemptions would be the residence, if the community spouse is going to be living there, and non-countable assets, which would be jewelry, household, and other sundry items, and a car. As far as income, once on the Medicaid assistance, income is redirected to the Medicaid system up to the cost of care, which is about 2/3 of private pay. And again, this is for the institutionalized spouse. The income allowance for community spouse is really a part of the code that allows the spouse to keep part of the income that normally would have gone for the care of the institutional spouse, but because the community spouse's income is so low, they get to keep some of that. The community spouse can keep income in their name, such as Social Security and pension benefits. So now let's take a look at how it flows. Let's say the husband gets sick. They're starting with $500,000. Well, they can keep, let's use 120 in this example, but 380 has to be spent down for his care. The home is exempt, so the $380,000 is the amount of spend down for the care of the spouse, the husband, before Medicaid will pay. Of course, there's other options that if you used in planning, we would have avoided this whole problem. But let's assume we just went straight forward to it, and this is what's going to happen. The wife can keep 120, and she can keep the income in her name. And if she goes into the nursing home, anything she's kept is up for grabs, but she does have an exemption of $1,600. So when the wife does end up in the nursing home, her assets are to take care of her up to the cost of confinement, but at $12,000 a month after taxes, obviously it's about $140,000 to $160,000 a year. Anything more than 2, 3, 4 years, most of those assets for the most of us would be lost. And normally, here's the problem that we wanted to talk about. Once that occurs where the husband and wife have gone through this system of confinement, there's really left, as far as very little left, if anything, for a legacy to the children. So we say, well, how do we create this? Well, the first thing is to avoid having all these assets being spent down, and there's ways of doing that. But the next thing is, if a lot of the assets are spent down, how do we create a new legacy? Because many families do want to leave their children and grandchildren assets. So what happens when both parents end up in a nursing home with there's no planning? Well, let's take $400,000. Well, we know 123 will go to the spouse. The spouse can keep the home. The 287 that's left out of that 400 would be spent down and for the care of the institutionalized spouse. And once you get on Medicaid, the Social Security and the pension are assigned to the Medicaid system to take care of the costs, but the spouse can keep their Social Security and pension. But again, once the spouse ends up in confinement, the community spouse, there's a $1,600 exemption, and that's the legacy. So we developed the 1% solution, which is a metaphor for really taking small amounts of your assets today and creating an estate. So again, this is a composite of what I've been talking about. A spouse goes in, 50% of the assets are kept up to a cap of 123. So in this case, I use 600 less the 123. That's the spend down. If no planning was done, that's the amount that has to be applied for the institutional spouse before Medicaid picks up. Once this is all spent down and Medicaid is picking up, this is what happens. There's leftover of $1,600. What we decided, though, is that if we can get the families to look at that and understand what's going on, we could set up a gifting program where we put 1%, 0.5%, some form of the estate into a special trust that would create an estate for the children and grandchildren. Here's a perfect example. Let's say we had a gifting program of $10,000 a year that we gifted to the kids. And come down here, you'll see the gift, the total gift over time, maybe the earnings on the gift if it was invested, the total value of the gift, and then upon the death of the parents, the explosion of tax-free benefits in the trust. So even if after 10 years, for an example, and I'll bring you into this, after 10 years, we have, let's say we've put in, we'll do 16 years. We've put in $160,000 in gifts to the kids. That's earned $5,500. That's worth $202,000. But the explosion into the trust at the parent's death is $341,000 of tax-free dollars, which is really 213% of the value, or $181,449 over and above the gift. The 139 represents over and above the gift with interest. So there is a way of putting some small dollars away every year in a gift program where it will create a much larger amount of assets for the family in the future to really recover a lot of the lost assets, or actually create a new estate if most, if not all, the assets are lost. And if you do have an interest in knowing more about it, please contact me at the above number, 203-530-6615, or email me at necgginc@icloud.com. You can go to our website at bbpgrp.com. And I will send you some material, and we could also have a free conversation on the phone. So thanks for taking this time. I certainly appreciate it.